Here is the exact scan I run every time I open a client's balance sheet. 5 lines, 60 seconds, and I can tell you whether a business is healthy or quietly heading towards a cash crunch. The thing is, most business owners never look at their balance sheet. They check the profit and loss and see a profit and assume everything is fine. But profit on paper and cash in the bank are two completely different things. I've seen businesses with strong profits go broke, and I've seen businesses with average profits build serious wealth. The difference almost always shows up on the balance sheet first. So in this video, I'm going to walk you through the exact CFO method I use with clients. We will cover the 5 lines that matter the most, the red flags that predict a cash crunch from 30 to 90 days out, and the 1 monthly habit that will change how you run your business. So let's dive in. Before we get into the scan, you need to understand why the balance sheet matters in the first place. Think of it this way. Your profit and loss statement tells you how the race went. Your balance sheet tells you whether your car can finish the next one. The P&L shows revenue minus expenses. That is your profit, but it is accounting profit, not actual cash. Especially if you are running your accounts on an accrual basis, which most businesses are. You might have invoices out that have not been paid yet. The P&L does not care. It just matches revenue to expenses. The balance sheet is different. It is a snapshot of what you actually own, what you actually owe, and what is left over. Assets minus liabilities equals equity. That's the accounting equation. Now here's where it gets interesting. When I sit down with a new client and they tell me they're busy but have no money, the answer is almost always on the balance sheet, not the P&L. One client came to us and they were really profitable on paper. Cash flow was okay, but tight, and they could not figure out why. Turned out they had taken $500,000 out of the business in director loans. The P&L looked great. The balance sheet told the real story. So let me show you exactly what to look for. Firstly, let me give you a warning. Everything I'm about to show you is useless if your data is wrong. If your bookkeeping is a mess, if transactions are not reconciled, if things are sitting in the wrong accounts, then you are making decisions based off bad information. That is dangerous. So step 0, before you even think like a CFO, is make sure your bookkeeping is clean. If you do not have a bookkeeper, get one. If you do have one, make sure they're doing monthly reconciliations and your reports are accurate. Once you have good data, you can implement the CFO strategy to ensure your balance sheet is giving you all the right answers. Skip this next step and everything else I teach you is worthless. Okay, so the first line I look at is cash. What is the actual balance sitting in the bank? But I don't just look at that number. I compare it to operating expenses. The question I'm asking here is, do we have enough runway? Here is the benchmark. You want at least 3 months of operating expenses sitting in cash, not cost of goods sold, but operating expenses. That is your rent, wages, subscription, and your insurance. The stuff that goes out whether you make a sale or not. 3 months is good, 6 months is better, 12 months is fantastic. Now, I know if you're just starting out, 3 months feels impossible. That is fine. It is something you build toward, but you need to know the target. The second line I check is accounts receivable. This is money people owe you, but the number itself does not tell me much. What I really want to know is how long it takes to get paid. We call this accounts receivable days. If you issue an invoice today, how many days on average until that cash hits your account? Here is where I see businesses get into trouble. They have a really strong P&L, revenue is up, profit looks good, but their accounts receivable is blowing out. They are doing the work, issuing invoices, but not getting paid for 60, 90, and sometimes even 120 days. Meanwhile, they still have to pay wages. They still have to pay suppliers. They still have to pay rent. That is how profitable businesses run out of cash. If you want to pull one lever that will immediately improve your cash position, this is it. Get paid faster. Third, I like to look at the liability side of things. Accounts payable is what you owe suppliers. Tax liabilities include your GST and PAYG withholding, superannuation and income tax. Here is what I see constantly. Business owners treat the cash in their bank account as if it's all theirs, but it's not. The truth is 10% of every dollar that comes in belongs to the tax office as GST. A portion of every wage payment is PAYG and super that you are holding on the staff's behalf. If you are not putting that money aside, you are spending the tax office's money. And when the BAS comes due, you will get a shock. The fix is simple. Set up a second bank account. Every time you do payroll, transfer that PAYG and super into that account. Every time revenue comes in, transfer 10% for GST. When the BAS arrives, the money is already there. Fourth, I look at fixed assets and any associated debt. If you have vehicles, equipment, or machinery on the balance sheet, I want to know two things. Are these assets actually used to generate income? And what does the debt look like? Here is a trap I see with tradies especially. They finance a bunch of vehicles and equipment, and the monthly repayments do not show up on the P&L. Only the interest does. The principal repayment sits on the balance sheet. So they look at their P&L and see a profit and wonder why they have no cash. The answer is the loan repayments eating it away. If you have financed assets, you need to know when those balloon payments fall due. Get on the front foot with your broker or bank. Do not let it surprise you. Finally, I look at the net assets, the total assets minus total liabilities. This tells me if everything went wrong tomorrow, could this business cover its debts? You want to see a strong net asset position, more assets than liabilities. You want to see the position improving over time, not going backwards. If your net assets are negative or shrinking, that is a red flag. It means the business is becoming weaker, even if the P&L looks okay. So those are the 5 lines I look at first for every client. Now let me tell you what specifically triggers alarm bells. The biggest one is the accounts receivable aging report. If I see a large portion of your receivables sitting at 60 or 90 days overdue, that tells me cash is about to get really tight. You have already done the work, you've already incurred the expenses, but the money is not coming in. The second red flag is a shrinking cash buffer, combined with growing liabilities. If your cash is going down while your payables or tax debts are going up, you're heading for a crunch. The third is large director's loans. Again, if the business is profitable, but the director has taken out hundreds of thousands of dollars, that explains where the cash went. The P&L will not show you that, the balance sheet will. If you take one thing from this video, it's this: start reviewing your numbers monthly. If you are on zero, there's a report called the management report. It comes out of the box. It shows you your P&L, your balance sheet, your receivables, your payables, your cash position, and how long it takes for you to get paid, as well as your average invoice size. Everything. Pull that report once a month, sit down for 30 minutes and actually look at it. Compare it to last month. Look for trends. If you don't understand it, that's fine. Spend the time to learn or bring it to your accountant and ask them to explain it. The business owners who understand their numbers make better decisions. They scale smarter, they avoid surprises, and they sleep better at night. If this video rings true to you, get in touch with our team in the link below.